Longacres Finance here with an update to the investment themes for the future. In today's video, I will talk about the alternative ETFs I've personally invested in and discuss why I have chosen to allocate my capital to these industries. I will show you how my personal investments to these ETFs have performed thus far, and we will wrap up with a short discussion on introducing a risk into your portfolio. In early November 2020, I released a video introducing 5 alternative ETFs that I have chosen to add to my portfolio. Those ETFs were AIQ, ESPO, IPO, OGIG, and SMOG. You can check out that video in the link above. I chose these 5 ETFs because I believe they will give me exposure to industries that I believe will grow faster than average in the future. I will talk more about that later in the video. First, let me explain what each of these funds is focused on. AIQ is an exchange-traded fund from Global X, and it is focused on future analytics. ESPO is a VanEck Vectors exchange-traded fund focused on gaming and esports. IPO is a Renaissance exchange-traded fund that provides exposure to recent initial public offerings. These are the companies that decided to go public by offering shares of their companies on the stock exchange. OGIG is an O-shares exchange-traded fund focused on global internet giants, the likes of Amazon, Google, Facebook, and Alibaba, to name a few. And SMOG, the VanEck Vectors exchange-traded fund, focused on low-carbon energy. They target green energy themes like solar, wind, and other renewables. The reason I chose exchange-traded funds instead of identifying individual stocks is because this makes life a little easier for me. The portfolio managers who run these funds are experts in what they do. They are supported by a team of analysts whose main job is to research their respective industry. I think that they are more likely to make smarter decisions than I would in their space. Therefore, my capital is more efficiently utilized by investing in them rather than trying to duplicate what they do. Obviously, their efforts have to be compensated, and that is why each of these funds carries a pretty high expense ratio. AIQ has an expense ratio of 68 basis points, ESPO 55 basis points, IPO 60 basis points, OGIG 48 basis points, and SMOG 62 basis points. If you're unfamiliar with how expense ratios work, let me break it down for you. The expense ratio is stated in basis points. 1 basis point is 1/100th of a percent. So for AIQ, the 68 basis points are equivalent to 0.68%. This is the annual rate charged on your total investment in the fund. So for every $1,000 invested in AIQ, you are paying $6.80 annually. Of course, you never actually see this fee or receive any invoice to pay. The fee is deducted from the fund price on a daily basis. It's usually fractions of pennies, therefore you don't see the market price shift as a result of paying the fee. As all this happens behind the scenes, many investors don't pay much attention to it. But you should always be aware of what fees you are paying, because they can eat away a significant amount of your future returns. These 5 funds are expected to grow more than average in the future, therefore they can justify having a high expense ratio. Moving on, in December of 2020, I added an additional 5 alternative ETFs to my portfolio. You can check out that video using the link above. Those ETFs are ARKG, the ARK Investments Genomic Revolution Exchange Traded Fund. What the heck is that? It's basically DNA mapping and all the wonderful healthcare advancements we will see in the future as a result of that branch of science. ARKK, another ARK investment exchange-traded fund focused on innovation. This fund targets disruptive innovation. I'm sure you've heard that term before, disruptive, probably linked to Amazon disrupting various industries. Well, Amazon isn't the only company creating disruption through innovation, and this fund seeks to focus on companies that are either doing just that right now or are poised to do that in the future. BETS, the Round Hill Sports Betting and iGaming Exchange-Traded Fund. This one is pretty self-explanatory. Sports betting is becoming a wave in the United States, as more and more states legalize that wonderful habit. TOKE, the Cambria Exchange-Traded Fund focused on cannabis, and YOLO, the Advisor Shares Pure Cannabis Fund. This is also another industry that has come into the spotlight recently. The expense ratios for these 5 funds are 42 basis points for TOKE and 75 basis points for all the other 4. If you're enjoying the video, show me by clicking the like button. And while you're clicking on buttons, might as well subscribe to my channel, so you don't miss any future videos. Let's take a second and talk about how much each of these industries is expected to grow in the future. First off, big data and artificial intelligence. Various online reports project this industry to grow by about 40% annually for the next few years. People generate and consume more data today than at any point in history, and those figures are only expanding. Many companies are still figuring out how to leverage the data they have. It's been said that the current stored data is the most valuable resource on the planet, and guess what? You don't own most of your data online, but you can own a piece of the companies that stand to benefit from this growth. With a fund like AIQ, disruptive innovation is defined as an innovation that creates a new market, that disrupts an existing market. Think about Tesla transforming the auto industry with their electric vehicles. There are many companies out there trying to do the same thing across multiple industries. Some will succeed and others may not. This is why I have decided to place my bet on a bag of these companies to hedge my risk. You can get exposure to this investment theme through the ARKK fund. The genomic revolution is already underway, but the expansion in the future will be exponential. We already have available certain therapeutic treatments through CRISPR, and DNA sequencing is driving innovation across the healthcare industry. As the technology expands, with more scientific breakthroughs, the possibilities are endless to the benefits this revolution can bring. You can jump on board for the ride with the ARKG fund. Sports betting is heating up in the United States, as we join the rest of the world that already has legal sports betting. Okay, so not the whole world, but most of Europe and parts of Asia are ahead of us with sports gambling. The US sports betting market is expected to be $1.5 billion in 2021, and to double by 2023. A bold estimate by H2 Gambling Capital puts the market at $81 billion by 2030. Now that's quite a jump. However, when you consider the estimated amount wagered illegally on sports in the United States is $150 billion per year, H2's estimate seems quite reasonable. You can take a bet on the industry with the BETS fund. Esports have been attracting more users year after year, and that growth has carried through to the value for the industry. In 2020, the industry was valued at $950 million, and is projected to almost double in the next 3 years. But you can't think of the esports industry as just the games that are popular and the companies that develop them. There are many beneficiaries from this growth, like the semiconductors, that make the components that allow this industry to exist. There are venues that host these events now, and server farms that also benefit from the industry. To get broad exposure to this growing industry, you can invest in a fund like ESPO. IPOs have always been sought after investments. However, not all of them are always a boom. Also, if you wanted to invest a sizable chunk of money into each IPO to hedge your bet, you'd need a big chunk of dry powder. There were 480 IPOs in the US stock market in 2020. How do you pick the right ones? Well, why not let smart analysts do the legwork for you by investing in a fund like IPO? Internet giants have been growing and growing for years now, inching their way into new industries or buying up small competitors. These companies will carve out such a large chunk of the market that it will be very difficult for new companies to challenge them. I think many of them will at some point turn into cash cows that will generate a ton of free cash flow they can later pass on to loyal investors. Betting on internet giants carries a little less risk compared to the other more disruptive smaller industries. Most of these companies can weather a recession and come out more streamlined on the other side. You can bet on the big internet boys with a fund like OGIG. Green energy is the future. The theme is becoming more broadly accepted by cities and countries around the world. With the cost of providing renewable energy decreasing and consumption levels increasing, the industry is bound to grow. I think the future of energy is green. Green like money. Catch the green bug with a fund like SMOG. The cannabis industry has been growing globally and domestically. Numerous states in the US have already legalized recreational use, and I think federal legalization is bound to come sooner or later. You can get exposure to the industry with an exchange-traded fund like TOKE or YOLO. I think all of these investment themes will have a bright future. You should make up your own mind though, and choose the fund that fits your outlook on the future. Let me show you how each of these funds has performed for me thus far. I have approximately 20% of my portfolio allocated to these ETFs, in addition to VGT and VUG. VGT is Vanguard's Information Technology Fund, and VUG is just a large cap growth fund. Out of that 20%, about 7% goes to the two funds I just mentioned. I bought each of those funds back in June of 2020, and the other ETFs were all purchased slowly between November 2020 and now. Matter of fact, I just added a share of AIQ a few days ago. As new money goes into my portfolio, I will try to keep it split at 20% allocated to these 12 funds, and the other 80% allocated to quality dividend stocks. I track my portfolio on Seeking Alpha, and here you can see each of the positions I have, as well as the returns. Let's run through them all. So here you can see I have 36 shares of AIQ with an average cost of $25.32. So the total gain on my position is $85.32, and I'm up 9.36%, with a value just shy of $1,000. For ARKG, I have 12 shares at an average cost of $92.84. I am up $138 thus far, or about 12.39%, with about $1,250 in value. For ARKK, I have 9 shares at a cost of $123.23. I am up $159.84, which is about 14.41%, with a value of $1,268. I own 29 shares of BETS at an average cost of $24.50. The position is up $121.51. or 17% since I started. I only have about $832 in this fund. ESPO, I own 13 shares at an average cost of $63.70. It is up $110 or 13.3%. IPO, I own 15 shares at an average cost of $58. It is up $154 or 17.5%. OGIG, I own 18 shares at an average cost of $49.61. It is up $111 or 12.4%. SMOG is my best performer thus far. I only have 7 shares at an average cost of $141.56, but it is up $341.71 or 34.5%. TOKE, I own 52 shares at an average cost of $15.46. The position is up $92.66 or about 11.5%. And skipping down here to YOLO, I own 45 shares at a cost of just shy of $17. It is up $167 or about 22% since I started. And the two funds I mentioned earlier, VGT, Vanguards Information Technology Fund, I own 9 shares of that and it's up just shy of $700 or about 27%. Vanguard's Large Cap Growth, I own 12 shares and that position is up just north of $600 or about 25%. Keep in mind I bought these two back in June and the rest were bought around November or December. Collectively, I am up $2,700 on all these positions or about 20% since inception. Total value is about $16,700. Let's shift gears now and talk about investing risk. The 10 ETFs I presented in this video carry significant risk of above average volatility. While I believe they will outperform the broad market in the long term, they could potentially see wild swings in the short term if we encounter any economic disruptions. I have chosen to allocate 20% of my portfolio to these higher risk investments because I have a long-term outlook. By long-term, I mean the next 10 to 20 years. I also know that I will be able to confidently hold on to them even if the market value drops by 50% or more. Each investor should take their timeline and risk tolerance into account when they decide how much of their portfolio to allocate to higher risk investments. Getting an extra few percentage points per year over a long period of time can have exponential results on your ending portfolio value. But you need to be comfortable with the risk. Otherwise, the potential of additional capital may not be worth the trouble. Good luck in your investing journey. Let me know if you're invested in any of these funds in the comments below. Thanks for watching. See you next time.